Balance of payment of a country is defined as the record of all economic transactions between the residents of a country and the rest of the world in a particular period. These transactions are made by individuals, firms and government bodies. Thus, balance of payments includes all visible and non-visible transactions of a country during a given period, usually a year. It represents a summation of country's current demand and supply of the claims on foreign currencies and of foreign claims on its currency. Balance of payments accounts are an accounting record of all monetary transactions between a country and the rest of the world. These transactions include payments for the country's exports and imports of goods, services, financial capital, and financial transfers. The BOP accounts summarize international transactions for a specific period, usually a year, and are prepared in a single currency, typically the domestic currency for the country concerned. Sources of funds for a nation, such as exports or the receipts of loans and investments, are recorded as positive or surplus items. Uses of funds, such as for imports or to invest in foreign countries, are recorded as negative or deficit items. When all components of the BOP accounts are included, they must sum to zero with no overall surplus or deficit. For example, if a country is importing more than it exports, its trade balance will be in deficit, but the shortfall will have to be counterbalanced in other ways, such as by funds earned from its foreign investments, by running down central bank reserves, or by receiving loans from other countries. While the overall BOP accounts will always balance when all types of payments are included, imbalances are possible on individual elements of the BOP, such as the current account, the capital account excluding the central bank's reserve account, or the sum of the two. Imbalances in the latter sum can result in surplus countries accumulating wealth, while deficit nations become increasingly indebted. The term balance of payments often refers to this sum. A country's balance of payments is said to be in surplus by a specific amount if sources of funds exceed uses of funds by that amount. There is said to be a balance of payments deficit if the former are less than the latter. Under a fixed exchange rate system, the central bank accommodates those flows by buying up any net inflow of funds into the country or by providing foreign currency funds to the foreign exchange market to match any international outflow of funds, thus preventing the funds flows from affecting the exchange rate between the country's currency and other currencies. Then the net change per year in the central bank's foreign exchange reserves is sometimes called the balance of payments surplus or deficit. Alternatives to a fixed exchange rate system include a managed float where some changes of exchange rates are allowed, or at the other extreme a purely floating exchange rate. With a pure float, the central bank does not intervene at all to protect or devalue its currency, allowing the rate to be set by the market, and the central bank's foreign exchange reserves do not change. Historically, there have been different approaches to the question of how or even whether to eliminate current account or trade imbalances. With record trade imbalances held up as one of the contributing factors to the financial crisis of 2007 (2010), plans to address global imbalances have been high on the agenda of policymakers since 2009. The current account shows the net amount a country is earning if it is in surplus, or spending if it is in deficit. It is the sum of the balance of trade, factor income and cash transfers. It is called the current account as it covers transactions in the here and now, those that don't give rise to future claims. The capital account records the net change in ownership of foreign assets. It includes the reserve account, along with loans and investments between the country and the rest of the world. The term capital account is also used in the narrower sense that excludes central bank foreign exchange market operations. Sometimes the reserve account is classified as below the line, and so not reported as part of the capital account. Expressed with the broader meaning for the capital account, the BOP identity assumes that any current account surplus will be balanced by a capital account deficit of equal size or alternatively a current account deficit will be balanced by a corresponding capital account surplus. The balancing item, which may be positive or negative, is simply an amount that accounts for any statistical errors and assures that the current and capital accounts sum to zero. By the principles of double entry accounting, an entry in the current account gives rise to an entry in the capital account, and in aggregate the two accounts automatically balance. A balance isn't always reflected in reported figures for the current and capital accounts, which might, for example, report a surplus for both accounts, but when this happens it always means something has been missed. Most commonly, the operations of the country's central bank and what has been missed is recorded in the statistical discrepancy term. An actual balance sheet will typically have numerous subheadings under the principal divisions. For example, entries under current account might include, trade a buying and selling of goods and services, exports a credit entry, imports a debit entry, trade balance the sum of exports and imports. Factor income a repayments and dividends from loans and investments, factor earnings a credit entry, factor payments a debit entry, factor income balance the sum of earnings and payments. Especially in older balance sheets, a common division was between visible and invisible entries. Visible trade recorded imports and exports of physical goods. Invisible trade would record international buying and selling of services, and sometimes would be grouped with transfer and factor income as invisible earnings. The term balance of payments surplus refers to the sum of the surpluses in the current account and the narrowly defined capital account. Denoting the balance of payments surplus as BOP surplus, the relevant identity is. Variations in the use of term balance of payments. Economics writer J. Allen Grab warns the term balance of payments can be a source of misunderstanding due to divergent expectations about what the term denotes. Grab says the term is sometimes misused by people who aren't aware of the accepted meaning, not only in general conversation but in financial publications and the economic literature. A common source of confusion arises from whether or not the reserve account entry, part of the capital account, is included in the BOP accounts. The reserve account records the activity of the nation's central bank. If it is excluded, the BOP can be in surplus or in deficit. The term balance of payments is sometimes misused by non-economists to mean just relatively narrow parts of the BOP such as the trade deficit, which means excluding parts of the current account and the entire capital account. Another cause of confusion is the different naming conventions in use. Before 1973 there was no standard way to break down the BOP sheet, with the separation into invisible and visible payments sometimes being the principal divisions. The IMF have their own standards for BOP accounting which is equivalent to the standard definition but uses different nomenclature, in particular with respect to the meaning given to the term capital account. The IMF definition, the International Monetary Fund use a particular set of definitions for the BOP accounts, which is also used by the Organization for Economic Cooperation and Development, and the United Nations System of National Accounts. The main difference in the IMF's terminology is that it uses the term financial account to capture transactions that would under alternative definitions be recorded in the capital account. The IMF uses the term capital account to designate a subset of transactions that, according to other usage, form a small part of the overall capital account. The IMF separates these transactions out to form an additional top-level division of the BOP accounts. Expressed with the IMF definition, the BOP identity can be written. The IMF uses the term current account with the same meaning as that used by other organizations, although it has its own names for its three leading subdivisions, which are, the goods and services account, the primary income account, the secondary income account, imbalances. While the BOP has to balance overall, surpluses or deficits on its individual elements can lead to imbalances between countries. In general there is concern over deficits in the current account. Countries with deficits in their current accounts will build up increasing debt and or see increased foreign ownership of their assets. The types of deficits that typically raise concern are, a visible trade deficit where a nation is importing more physical goods than it exports, an overall current account deficit. A basic deficit which is the current account plus foreign direct investment, as discussed in the history section below. The Washington Consensus periods saw a swing of opinion towards the view that there is no need to worry about imbalances. Opinions swung back in the opposite direction in the wake of financial crisis of 2007–2009. Mainstream opinion expressed by the leading financial press and economists, International bodies like the IMF as well as leaders of surplus and deficit countries has returned to the view that large current account imbalances do matter. Some economists do, however, remain relatively unconcerned about imbalances, and there have been assertions, such as by Michael P. Dooley, David Fokerts-Landor and Peter Garber, that nations need to avoid temptation to switch to protectionism as a means to correct imbalances. Causes of BOP imbalances. There are conflicting views as to the primary cause of BOP imbalances, with much attention on the US, which currently has by far the biggest deficit. The conventional view is that current account factors are the primary cause. These include the exchange rate, the government's fiscal deficit, business competitiveness, and private behavior such as the willingness of consumers to go into debt to finance extra consumption. An alternative view, argued at length in a 2005 paper by Ben Bernanke, is that the primary driver is the capital account, where a global savings glut caused by savers in surplus countries, runs ahead of the available investment opportunities, and is pushed into the US, resulting in excess consumption and asset price inflation. Reserve asset. In the context of BOP and international monetary systems, the reserve asset is the currency or other store of value that is primarily used by nations for their foreign reserves. BOP imbalances tend to manifest as hoards of the reserve asset being amassed by surplus countries, with deficit countries building debts denominated in the reserve asset or at least depleting their supply. Under a gold standard, the reserve asset for all members of the standard is gold. In the Bretton Woods system, either gold or the US dollar could serve as the reserve asset, though its smooth operation depended on countries apart from the US choosing to keep most of their holdings in dollars. Following the ending of Bretton Woods, there has been no de jure reserve asset, but the US dollar has remained by far the principal de facto reserve. Global reserves rose sharply in the first decade of the 21st century, partly as a result of the 1997 Asian financial crisis, where several nations ran out of foreign currency needed for essential imports and thus had to accept deals on unfavorable terms. The International Monetary Fund estimates that between 2000 to mid-2009, official reserves rose from $1,900 billion to $6,800 billion. Global reserves had peaked at about $7,500 billion in mid-2008. Then declined by about $430 billion as countries without their own reserve currency used them to shield themselves from the worst effects of the financial crisis. From February 2009, global reserves began increasing again to reach close to $9,200 billion by the end of 2010. As of 2009, approximately 65% of the world's $6,800 billion total is held in US dollars and approximately 25% in euros. The UK pound, Japanese yen, IMF special drawing rights, and precious metals also play a role. In 2009, Zhou Xiaohuan, governor of the People's Bank of China, proposed a gradual move towards increased use of SDRs, and also for the national currencies backing SDRs to be expanded to include the currencies of all major economies. Dr. Zhou's proposal has been described as one of the most significant ideas expressed in 2009. While the current central role of the dollar does give the US some advantages, such as lower cost of borrowings, it also contributes to the pressure causing the US to run a current account deficit, due to the Triffin dilemma. In a November 2009 article published in Foreign Affairs magazine, economist C. Fred Bergsten argued that Dr. Zhou's suggestion or a similar change to the international monetary system would be in the United States' best interests as well as the rest of the world's. Since 2009 there has been a notable increase in the number of new bilateral agreements which enable international trades to be transacted using a currency that isn't a traditional reserve asset, such as the renminbi, as the settlement currency. Balance of payments crisis. A BOP crisis, also called a currency crisis, occurs when a nation is unable to pay for essential imports and/or service its debt repayments. Typically, this is accompanied by a rapid decline in the value of the affected nation's currency. Crises are generally preceded by large capital inflows, which are associated at first with rapid economic growth. However, a point is reached where overseas investors become concerned about the level of debt their inbound capital is generating, and decide to pull out their funds. The resulting outbound capital flows are associated with a rapid drop in the value of the affected nation's currency. This causes issues for firms of the affected nation who have received the inbound investments and loans, as the revenue of those firms is typically mostly derived domestically but their debts are often denominated in a reserve currency. Once the nation's government has exhausted its foreign reserves trying to support the value of the domestic currency, its policy options are very limited. It can raise its interest rates to try to prevent further declines in the value of its currency, but while this can help those with debts denominated in foreign currencies, it generally further depresses the local economy. Balancing mechanisms. One of the three fundamental functions of an international monetary system is to provide mechanisms to correct imbalances. Broadly speaking, there are three possible methods to correct Bo P imbalances, though in practice a mixture including some degree of at least the first two methods tends to be used. These methods are adjustments of exchange rates, adjustment of a nation's internal prices along with its levels of demand, and rules-based adjustment. Improving productivity and hence competitiveness can also help, as can increasing the desirability of exports through other means, though it is generally assumed a nation is always trying to develop and sell its products to the best of its abilities. Rebalancing. By changing the exchange rate, an upwards shift in the value of a nation's currency relative to others will make a nation's exports less competitive and make imports cheaper and so will tend to correct a current account surplus. It also tends to make investment flows into the capital account less attractive, so will help with a surplus there too. Conversely, a downward shift in the value of a nation's currency makes it more expensive for its citizens to buy imports and increases the competitiveness of their exports, thus helping to correct a deficit. Exchange rates can be adjusted by government in a rules-based or managed currency regime, and when left to float freely in the market they also tend to change in the direction that will restore balance. When a country is selling more than it imports, the demand for its currency will tend to increase as other countries ultimately need the selling country's currency to make payments for the exports. The extra demand tends to cause a rise of the currency's price relative to others. When a country is importing more than it exports, the supply of its own currency on the international market tends to increase as it tries to exchange it for foreign currency to pay for its imports, and this extra supply tends to cause the price to fall. Bo P effects are not the only market influence on exchange rates, however, they are also influenced by differences in national interest rates and by speculation. Rebalancing. By adjusting internal prices and demand, when exchange rates are fixed by a rigid gold standard, or when imbalances exist between members of a currency union such as the Eurozone, the standard approach to correct imbalances is by making changes to the domestic economy. To a large degree, the change is optional for the surplus country, but compulsory for the deficit country. In the case of a gold standard, the mechanism is largely automatic. When a country has a favorable trade balance, as a consequence of selling more than it buys, it will experience a net inflow of gold. The natural effect of this will be to increase the money supply, which leads to inflation and an increase in prices, which then tends to make its goods less competitive and so will decrease its trade surplus. However, the nation has the option of taking the gold out of economy, thus building up a hoard of gold and retaining its favorable balance of payments. On the other hand, if a country has an adverse Bo P, it will experience a net loss of gold, which will automatically have a deflationary effect, unless it chooses to leave the gold standard. Prices will be reduced, making its exports more competitive, and thus correcting the imbalance. While the gold standard is generally considered to have been successful up until 1914, correction by deflation to the degree required by the large imbalances that arose after WWI proved painful, with deflationary policies contributing to prolonged unemployment but not re-establishing balance. Apart from the U.S., most former members had left the gold standard by the mid-1930s. A possible method for surplus countries such as Germany to contribute to rebalancing efforts when exchange rate adjustment is not suitable, is to increase its level of internal demand. While a current account surplus is commonly understood as the excess of earnings over spending, an alternative expression is that it is the excess of savings over investment. That is, where CA equals current account, NS equals national savings, NI equals national investment. If a nation is earning more than it spends, the net effect will be to build up savings, except to the extent that those savings are being used for investment. If consumers can be encouraged to spend more instead of saving, or if the government runs a fiscal deficit to offset private savings, or if the corporate sector divert more of their profits to investment, then any current account surplus will tend to be reduced. However, in 2009 Germany amended its constitution to prohibit running a deficit greater than 0.35% of its GDP, and calls to reduce its surplus by increasing demand have not been welcomed by officials, adding to fears that the 2010s will not be an easy decade for the Eurozone. In their April 2010 World Economic Outlook report, the IMF presented a study showing how with the right choice of policy options governments can transition out of a sustained current account surplus with no negative effect on growth and with a positive impact on unemployment. Rules-based rebalancing mechanisms: nations can agree to fix their exchange rates against each other, and then correct any imbalances that arise by rules-based and negotiated exchange rate changes and other methods. The Bretton Woods system of fixed but adjustable exchange rates was an example of a rules-based system. John Maynard Keynes, one of the architects of the Bretton Woods system, had wanted additional rules to encourage surplus countries to share the burden of rebalancing, as he argued that they were in a stronger position to do so and as he regarded their surpluses as negative externalities imposed on the global economy. Keynes suggested that traditional balancing mechanisms should be supplemented by the threat of confiscation of a portion of excess revenue if the surplus country did not choose to spend it on additional imports. However, his ideas were not accepted by the Americans at the time. In 2008 and 2009, American economist Paul Davidson had been promoting his revamped form of Keynes's plan as a possible solution to global imbalances, which in his opinion would expand growth all round without the downside risk of other rebalancing methods. History of balance of payments issues: historically, accurate balance of payments figures were not generally available. However, this did not prevent a number of switches in opinion on questions relating to whether or not a nation's government should use policy to encourage a favorable balance. Pre-1820, mercantilism: up until the early 19th century, international trade was generally very small in comparison with national output, and was often heavily regulated. In the Middle Ages, European trade was typically regulated at municipal level in the interests of security for local industry and for established merchants. From about the 16th century, mercantilism became the dominant economic theory influencing European rulers, which saw local regulation replaced by national rules aiming to harness the country's economic output. Measures to promote a trade surplus such as tariffs were generally favored. Power was associated with wealth, and with low levels of growth, nations were best able to accumulate funds either by running trade surpluses or by forcefully confiscating the wealth of others. Rulers sometimes strove to have their countries outsell competitors and so build up a war chest of gold. This era saw low levels of economic growth. Average global per capita income is not considered to have significantly risen in the whole 800 years leading up to 1820, and is estimated to have increased on average by less than 0.1% per year between 1700 and 1820. With very low levels of financial integration between nations and with international trade generally making up a low proportion of individual nations' GDP, BOP crises were very rare. 1820 a Euro 1914, free trade. From the late 18th century, mercantilism was challenged by the ideas of Adam Smith and other economic thinkers favoring free trade. After victory in the Napoleonic Wars, Great Britain began promoting free trade, unilaterally reducing her trade tariffs. Hoarding of gold was no longer encouraged, and in fact Britain exported more capital as a percentage of her national income than any other creditor nation has since. Great Britain's capital exports further helped to correct global imbalances as they tended to be counter-cyclical, rising when Britain's economy went into recession, thus compensating other states for income lost from export of goods. According to historian Carol Quigley, Great Britain could afford to act benevolently in the 19th century due to the advantages of her geographical location, its naval power and economic ascendancy as the first nation to enjoy an industrial revolution. A view advanced by economists such as Barry Eichengreen is that the first age of globalization began with the laying of transatlantic cables in the 1860s, which facilitated a rapid increase in the already growing trade between Britain and America. Though current account controls were still widely used, capital controls were largely absent, and people were generally free to cross international borders without requiring passports. A gold standard enjoyed wide international participation especially from 1870, further contributing to close economic integration between nations. The period saw substantial global growth, in particular for the volume of international trade which grew tenfold between 1820 and 1870 and then by about 4% annually from 1870 to 1914. BOP crises began to occur, though less frequently than was to be the case for the remainder of the 20th century. From 1880 to 1914, there were approximately 8 BOP crises and 8 twin crises a twin crisis being a BOP crisis that coincides with a banking crisis. 1914 1945, deglobalization, the favorable economic conditions that had prevailed up until 1914 were shattered by the First World War, and efforts to re-establish them in the 1920s were not successful. Several countries rejoined the gold standard around 1925. But surplus countries didn't play by the rules, sterilizing gold inflows to a much greater degree than had been the case in the pre-war period. Deficit nations such as Great Britain found it harder to adjust by deflation as workers were more enfranchised and unions in particular were able to resist downwards pressure on wages. During the Great Depression most countries abandoned the gold standard, but imbalances remained an issue and international trade declined sharply. There was a return to mercantilist-type beggar-thy-neighbor policies, with countries competitively devaluing their exchange rates, thus effectively competing to export unemployment. There were approximately 16 BOP crises and 15 twin crises, 1945 1971, Bretton Woods. Following World War II, the Bretton Woods institutions were set up to support an international monetary system designed to encourage free trade while also offering states options to correct imbalances without having to deflate their economies. Fixed but flexible exchange rates were established, with the system anchored by the dollar which alone remained convertible into gold. The Bretton Woods system ushered in a period of high global growth, known as the Golden Age of Capitalism. However, it came under pressure due to the inability or unwillingness of governments to maintain effective capital controls and due to instabilities related to the central role of the dollar. Imbalances caused gold to flow out of the U.S. and a loss of confidence in the United States' ability to supply gold for all future claims by dollar holders resulted in escalating demands to convert dollars, ultimately causing the U.S. to end the convertibility of the dollar into gold, thus ending the Bretton Woods system. The 1945–71 era saw approximately 24 BOP crises and no twin crises for advanced economies, with emerging economies seeing 16 BOP crises and just 1 twin crisis. 1971–2009, transition, Washington Consensus, Bretton Woods II. The Bretton Woods system came to an end between 1971 and 1973. There were attempts to repair the system of fixed exchange rates over the next few years, but these were soon abandoned, as were determined efforts for the U.S. to avoid BOP imbalances. Part of the reason was displacement of the previous dominant economic paradigm Keynesianism by the Washington Consensus, with economists and economics writers such as Murray Rothbard and Milton Friedman arguing that there was no great need to be concerned about BOP issues. In the immediate aftermath of the Bretton Woods collapse, countries generally tried to retain some control over their exchange rate by independently managing it, or by intervening in the foreign exchange market as part of a regional bloc, such as the Snake which formed in 1971. The Snake was a group of European countries who tried to retain stable rates at least with each other. The group eventually evolved into the European exchange rate mechanism by 1979. From the mid-1970s however, and especially in the 1980s and early 1990s, many other countries followed the U.S. in liberalizing controls on both their capital and current accounts, in adopting a somewhat relaxed attitude to their balance of payments and in allowing the value of their currency to float relatively freely with exchange rates determined mostly by the market. Developing countries who chose to allow the market to determine their exchange rates would often develop sizable current account deficits, financed by capital account inflows such as loans and investments, though this often ended in crises when investors lost confidence. The frequency of crises was especially high for developing economies in this era. From 1973 to 1997, emerging economies suffered 57 BOP crises and 21 twin crises. Typically but not always, the panic among foreign creditors and investors that preceded the crises in this period was usually triggered by concerns over excess borrowing by the private sector, rather than by a government deficit. For advanced economies, there were 30 BOP crises and 6 banking crises. A turning point was the 1997 Asian BOP crisis, where unsympathetic responses by Western powers caused policymakers in emerging economies to reassess the wisdom of relying on the free market. By 1999, the developing world as a whole stopped running current account deficits while the U.S. current account deficit began to rise sharply. This new form of imbalance began to develop in part due to the increasing practice of emerging economies, principally China, in pegging their currency against the dollar, rather than allowing the value to freely float. The resulting state of affairs has been referred to as Bretton Woods II. According to Alastair Chan, at the heart of the imbalance is China's desire to keep the value of the yuan stable against the dollar. Usually, a rising trade surplus leads to a rising value of the currency. A rising currency would make exports more expensive, imports less so, and push the trade surplus towards balance. China circumvents the process by intervening in exchange markets and keeping the value of the yuan depressed. According to economics writer Martin Wolf, in the 8 years leading up to 2007, 3/4 of the foreign currency reserves accumulated since the beginning of time have been piled up. In contrast to the changed approach within the emerging economies, U.S. policy makers and economists remained relatively unconcerned about BOP imbalances. In the early to mid-1990s, many free market economists and policy makers such as U.S. Treasury Secretary Paul O'Neill and Fed Chairman Alan Greenspan went on record suggesting the growing U.S. deficit was not a major concern. While several emerging economies had intervening to boost their reserves and assist their exporters from the late 1980s, they only began running a net current account surplus after 1999. This was mirrored in the faster growth for the U.S. current account deficit from the same year, with surpluses, deficits and the associated buildup of reserves by the surplus countries reaching record levels by the early 2000s and growing year by year. Some economists such as Kenneth Rogoff and Morris Obstfeld began warning that the record imbalances would soon need to be addressed from as early as 2001, joined by Nouriel Roubini in 2004. But it was not until about 2007 that their concerns began to be accepted by the majority of economists. 2009 and later, post-Washington Consensus, speaking after the 2009 G20 London Summit, Gordon Brown announced the Washington Consensus is over. There is now broad agreement that large imbalances between different countries do matter. For example, mainstream U.S. economist C. Fred Bergsten has argued the U.S. deficit and the associated large inbound capital flows into the U.S. was one of the causes of the financial crisis of 2007–2010. Since the crisis, government intervention in BOP areas such as the imposition of capital controls or foreign exchange market intervention has become more common and in general attracts less disapproval from economists, international institutions like the IMF and other governments. In 2007, when the crises began, the global total of yearly BOP imbalances was $1,680 billion. On the credit side, the biggest current account surplus was China with approximately $362 billion, followed by Japan at $213 billion and Germany at £185 billion, with oil-producing countries such as Saudi Arabia also having large surpluses. On the debit side, the U.S. had the biggest current account deficit at over $1,100 billion, with the UK, Spain and Australia together accounting for close to a further $300 billion. While there have been warnings of future cuts in public spending, deficit countries on the whole did not make these in 2009. In fact, the opposite happened, with increased public spending contributing to recovery as part of global efforts to increase demand. The emphasis has instead been on the surplus countries, with the IMF, EU and nations such as the US, Brazil and Russia asking them to assist with the adjustments to correct the imbalances. Economists such as Gregor Irwin and Philip Allain have suggested that increased use of pooled reserves could help emerging economies not to require such large reserves and thus have less need for current account surpluses. Writing for the FT in January 2009, Gillian Tett says she expects to see policymakers becoming increasingly concerned about exchange rates over the coming year. In June 2009, Olivier Blanchard, the chief economist of the IMF, wrote that rebalancing the world economy by reducing both sizable surpluses and deficits will be a requirement for sustained recovery. In 2008 and 2009, there was some reduction in imbalances, but early indications towards the end of 2009 were that major imbalances such as the U.S. current account deficit are set to begin increasing again. Japan had allowed her currency to appreciate through 2009, but has only limited scope to contribute to the rebalancing efforts thanks in part to her aging population. The euro used by Germany is allowed to float fairly freely in value, however further appreciation would be problematic for other members of the currency union such as Spain, Greece and Ireland, who run large deficits. Therefore, Germany has instead been asked to contribute by further promoting internal demand, but this hasn't been welcomed by German officials. China has been requested to allow the renminbi to appreciate but until 2010 had refused, the position expressed by her Premier Wen Jiabei being that by keeping the value of the renminbi stable against the dollar, China has been helping the global recovery, and that calls to let her currency rise in value have been motivated by a desire to hold back China's development. After China reported favorable results for her December 2009 exports, however, the Financial Times reported that analysts are optimistic that China will allow some appreciation of her currency around mid-2010. In April 2010, a Chinese official signaled the government is considering allowing the renminbi to appreciate, but by May analysts were widely reporting the appreciation would likely be delayed due to the fall in value of the euro following the 2010 European sovereign debt crisis. China announced the end of the renminbi's peg to the dollar in June 2010. The move was widely welcomed by markets and helped diffuse tension over imbalances prior to the 2010 G20 Toronto summit. However, the renminbi remains managed and the new flexibility means it can move down as well as up in value. 2 months after the peg ended, the renminbi had only appreciated against the dollar by about 0.8%. By January 2011, the renminbi had appreciated against the dollar by 3.7%. which means it's on track to appreciate in nominal terms by 6% per year. As this reflects a real appreciation of 10% when China's higher inflation is accounted for, the U.S. Treasury once again declined to label China a currency manipulator in their February 2011 report to Congress. However, Treasury officials did advise the rate of appreciation was still too slow for the best interests of the global economy. In February 2011, Moody's analyst Alistair Chan has predicted that despite a strong case for an upward revaluation, an increased rate of appreciation against the dollar is unlikely in the short term. And as of February 2012, China's currency had been continuing to appreciate for a year and a half, while drawing remarkably little notice. While some leading surplus countries including China have been taking steps to boost domestic demand, these have not yet been sufficient to rebalance out of their current account surpluses. By June 2010, the U.S. monthly current account deficit had risen back to $50 billion, a level not seen since mid-2008. With the U.S. currently suffering from high unemployment and concerned about taking on additional debt, fears are rising that the U.S. may resort to protectionist measures. Competitive devaluation after 2009. By September 2010, international tensions relating to imbalances had further increased. Brazil's finance minister Guido Mantega declared that an international currency war has broken out, with countries competitively trying to devalue their currencies so as to boost exports. Brazil had been one of the few major economies lacking a reserve currency to abstain from significant currency intervention, with the real rising by 25% against the dollar since January 2009. Some economists such as Barry Eichengreen have argued that competitive devaluation may be a good thing as the net result will effectively be equivalent to expansionary global monetary policy. Others such as Martin Wolf saw risks of tensions further escalating and advocated that coordinated action for addressing imbalances should be agreed on at the November G20 summit. Commentators largely agreed that little substantive progress was made on imbalances at the November 2010 G20. An IMF report released after the summit warned that without additional progress there is a risk of imbalances approximately doubling to reach pre-crisis levels by 2014. Why balance of payments is always balanced. The balance of payments account of a country is made on the principle of double-entry bookkeeping. Each transaction is entered either on the credits or on the debit side of the balance sheet. The credits are entered on left side and debits are entered on right side of balance sheet. Payments received from a foreign country is credit transaction whereas payment to a foreign country is a debit transaction. Therefore, the balance of payments is always balanced. Difference between balance of payments and balance of trade, see also, currency crisis, exchange rate regime, foreign exchange reserves, history of money, IMF balance of payments manual, sovereign default, sterilization, sudden stop, notes and citations. The Alternative Trader by Vladimir Petropoljak. Further reading. External links, data, comprehensive international BOP statistics from the IMF, BOP for Hong Kong, U.S. statistics, detailed historical BOP data from the U.S. Bureau of Economic Analysis, analysis, where do U.S. dollars go when the United States runs a trade deficit? From Dollars and Cents magazine. Report to Congress on International Economic and Exchange Rate Policies February 2011 U.S. Treasury Report with sections on BOP issues for major trading blocs and countries. Paper from the Bank of Canada on challenges for 2010 regarding current imbalances, in context of international monetary system history, European Central Bank paper on the accumulation of reserves and imbalances since 1995 hegemony a Euro analysis on BOP issues from a progressive Chinese perspective.